everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we have a fun one. This episode is going to be focused on a sell rating that was given to Realty Income. I was scrolling through Seeking Alpha the other day, and the main big bold headline of this article says, "Sell alert, Realty Income is overvalued." And I went over this article, and I wanted to give its reasons for why I think a company like Realty Income is overvalued. Because for me, that's really important. If you look at my top three holdings, it's Broadcom, Realty Income, and WP Carey. And Realty Income is tied for second place for my largest holding in my entire portfolio, and WP Carey being almost the exact same business model. So the triple net real estate lease agreement that these companies have are companies that I really believe in. They're business models that I really think are going to be successful for the long term. And so if an article like this is right, I want to know about it. I need to know if this is an opportunity for me to sell my shares in Realty Income. So we're going to go over this article, go over the reasons why I think they're either right or wrong with Realty Income, and then we're going to go over the company entirely, all focused on Realty Income, what they do, how they do it, how they grow their company, how the company has performed, their history, their track record, and then overall just everything you need to know about the company and if this is an accurate article, in my opinion, about Realty Income being overvalued. But before we jump into all that, my name is Jordan. I'm a millennial investor. Column A that I'm highlighting right here is the companies that I own, listed in column A right here. And then I also track my annual and monthly dividend income through these charts every single month right here, as well as my portfolio value and my monthly YouTube income. My top 5 investing goals are listed right here for 2021, as well as my 2021 stock market prediction. My goal is to get 150 of your people referred to M1 Finance by the end of the year. And so far, now that we're in June, we are doing very well. We are so far right now at 113 people successfully referred to M1 Finance. And right now you can get a $30 bonus for getting signed up. So if you want a free brokerage that has incredible features that I showcase in every single one of my videos, $30 is what you'll get for signing up. And that link is down below in the description. There's also other things as well, including auto savings accounts, credit card referrals, lots of other things like that. So go ahead and check that out. And thank you guys for tuning in. But Realty Income, it's the second largest position in my portfolio, currently makes up a little bit over $1,100. It's 8% of my target weighting. And then the total gain that I have in this company is $212.06. A money weighted return, which, like I always say, time weighted is much more accurate than money weighted, but still, a money weighted return of 48%. The market gain of that $212 in total gains is $183.50. The earned dividends that I've earned from this company is $28.56. I own 15.75 shares at an average cost basis of $58.63. And we go to my activity feed here. One of my favorite things that I love to show with this company is the track records of paying dividends from my account. If we look going back all the way to May when I first started this account, my first dividend payment was 60 cents. But since this company doesn't pay out every quarter, they pay out every month, I continually grow my investment, not only in share price but in dividends as well. My original payment of 60 cents then went to 70, to 71, to 83, to 95, to $1.42, $1.90, 209, 265, 287, 318, 344, 352, and that is how you grow your dividends as a dividend growth investor with a company like Realty Income. Now let's go ahead and jump into the sell rating and read over why these people think that Realty Income is overvalued. Now, if we go back just over a year ago, they said that if you were not buying Realty Income, you'd regret it. And it says, as the pendulum has swung, the stock is now overvalued. Now that the company has went up in share price, it is now no longer a good holding. Because a year ago when they stated this was during the pandemic, when this company was trading at the low 50s, the low 60s. And now that it's over $70 a share, they're now claiming that this is a company that you do not want to own. And scrolling down to the introduction, the first part of this is what I find is really interesting. It says, when you take a stock like Realty Income, ticker symbol O today, we have quite clear targets. Buy below 62, sell above 70, hold in between. Now, first off, I want to start off with, regardless of their reasons for buying or selling Realty Income, if you're looking at a difference in share price of about 10%, $70 to $62, that's roughly about a 10% difference. It's like 11 or 12. A 10% difference in stock price for any company, especially in an exceptional company like Realty Income, really doesn't matter. If you look at a company that's been one of the best performing stocks of the decade, a Home Depot, does it really matter 5 years ago if you bought this company at 125 or 140? I don't really think so. Because like look in 2016, this company traded at 125 back in June 2016, and then about 140 in July and August of 2016, a couple months later. Would it have really mattered which price you bought it at? It would have been better to buy it lower, of course. Like all investors, it's better to buy low and sell high. But would it have really mattered if you bought within a 10% difference? Because whether you bought at 125 or 140, fast forward to today, this company's over 300, and that's not even counting dividends, and you would have had incredible returns, basically doubling up your money over the last 5 years. Or another great company. What about an exceptional company that has grown to the largest on the planet of over $2 trillion? Go back 5 years ago, and this company was a significantly smaller company. Right now, it trades at 127 a share, and 5 years ago, this was $24. So once again, a 10% swing. Does it really matter if you buy this company at 24 or 27 or 28? It doesn't really matter because if you're making the right decisions and buying exceptional companies at realistic prices, you're going to be successful in the long run. And so 5 years ago, if you bought Apple at 25, if you bought Apple at 30, if you bought Apple at $50 a share, you're probably very happy with your investment. Now that it is over $100 a share, not even counting dividends reinvested. So going back to Realty Income, if you're right and you identify that this company is an exceptional company, we're about to go over all the reasons why I think this is an exceptional company. But if you're buying this, I don't think it really matters if you're buying at these prices or 10% lower, maybe even 10% higher. If you're buying this company at, say, $500 a share, then that's really offensive and you probably shouldn't be buying this company. But owning companies at fair prices is what I look to do that will be successful in the long run. So that's where they start off, is that you should be buying below 62, selling above 70, and then holding anything between. Okay? And then once again, going back to the prices, this is their history of posting about Realty Income. In January of 2020, right before the pandemic struck, they put that Realty Income is a slam dunk below $60. It was at 59. A couple months later, in May of 2020, they put buy Realty Income now or regret it later. And then next they put in September of 2020, about 6 months or so ago, they put yes, you should buy Realty Income, but maybe not now. And that is all just within a couple dollars. They said at 59, it's an absolute slam dunk. But at 64, you shouldn't probably buy it right now. So it's really interesting to see how small of a share price difference will sway these people's opinions, because it looks like they're trying to pick up pennies while they're skipping over dollars. Next, we move to how they determine Realty Income's price targets. The stock's price relative to its historical valuation is the first one, and then the second is the stock's future income potential. They move on to what have investors historically paid for Realty Income. So we can look 10 years back and ask, what have historical investors typically paid for Realty Income's dividend? And they go on to show historical averages between the dividend yield between 3.3 and 4.5%, and that they want to buy within the fair range of those dividend yields. And the issue with this is that you're buying nothing in regards to the business, buying nothing in regards to the share price. This is based off of just what the dividend yield is, which while it's not a horrible metric to look at dividend yield, that doesn't really tell the whole story. And then number two, what's Realty Income's future income potential? It talks about the growth rate of Realty Income versus competitors like higher growers like a Home Depot, low yield versus high growth, Home Depot, L3 Harris, Dick's Sporting Goods, mid yield, mid growth, high yield, low growth. And it talks about Realty Income and the value of its growth versus its dividend yield. And it talks about, since it has little to no growth in its dividend yield, that this is a company that will not be a great performer and you should be careful of what prices you're buying at. And so they move on to say why Realty Income is not an opportunity to be buying the company right now. And they say how this translates its information to a sell rating. It says, having looked both into the rear view mirror into the crystal ball, we're able to see that Realty Income is entering historically overvalued territory and has merely okay dividend potential. This is definitely not a time to be purchasing Realty Income, and in fact is one to start thinking about selling. Multiple times, price has failed to drive the yield below 4%, marking a top for Realty Income. What's more, the $70 level has seen strong price resistance historically, with the stock failing to make much progress from that level in the past 5 years. All these prices of information together motivate us to sell 25% of our Realty Income position when it hits $70. In conclusion, selling based on valuation is not easy, but if you want to get the most out of your dividend portfolio, it is something you need to do. The oldest adage is buy low, sell high. If you're never selling, you're entering a fist fight with an arm tied behind your back. Hopefully this article sheds some light on why we believe realty income is overvalued and how we set our sale targets to reflect that it could still get quite a bit more expensive while taking some chips off the table. Now, what's really interesting about this is that this seems like a type of investor that is investing based off of a share price. They're more focused on prices and trying to trade in and out of the stock rather than investing in a business, investing in a company. And getting out of this article real quick and moving to realty income, I won't read through all this line by line, but if you're not familiar with Realty Income's business model, I'll put up some pieces of information for you to pause and just go over some bullet points. They own over 6,600 properties. By the way, they just had a merger, so they'll have a lot more than that. But they have over 6,000 properties with 600 different clients across 56 industries located in all 50 states, Puerto Rico, and the United Kingdom. They're an S&P 500 company that is a real estate investment trust, and as of today, this is actually not updated, it says 610. As of the other day, it's now 611 consecutive monthly dividends paid throughout its 52-year operating history. 611 consecutive dividend payments, and of that, they've raised the dividend 110 times, and they are on track to raise it even more. How they want to decide what properties they want to purchase, what real estate that they want to own and cash flow is based off of these type of criterias. Clients with reliable and sustainable cash flow, good businesses, profitable businesses, not any type of speculative companies, not like an electric vehicle company that may or may not make a profit 10 years from now. These are reliable, sustainable businesses like Home Depot, Walgreens, Walmart, Taco Bell. These are companies that have revenue and cash flow from multiple sources. Clients that are willing to sign a long-term lease, that plan on being in business 10 years plus, decades out. Clients that are large owners and users of real estate. Capital intense businesses that require physical properties to operate their business. Realty income. Real estate that is critical to the client's ability to generate revenue, i.e., they need the property in which they operate and to conduct their business. As I said, capital intense businesses that require physical property. Real estate with property valuations that approximate replacement costs, and real estate with rental or lease payments that approximate market rents. Now, this company looks for that type of criteria, and after they look at acquiring those properties, this is how they analyze the merits of their potential acquisition. This is all on their website, by the way. These are their words, not mine or not some type of analyst. This is all from Realty Income. Number one, if the tenant represents a reliable source of lease revenue. Number two, if the property is in a strategic location critical to generating revenue. Number three, if the acquisition is appropriate relative to the diversification of our portfolio. Number four, if the industry is favored relative to economic trends, macroeconomic trends. Number five, if the property is priced near replacement costs and leased at rents that approximate market rents. And then their business model. Once they acquire those properties, once they identify that they're cash flowing, they identify that those businesses need the real estate, they identify that it's going to be in a growing category or will help diversify their portfolio, it's the type of property that they want to own. Once they buy it, the mission's not over. The goal's not over. They talk about how they grow their earnings from not only new properties, but existing properties as well. The first one is to increase the size of their real estate portfolio. Obviously, buy out more properties. And now, right now, they own about 6,600 properties. Next year, let's make that 6,700. Let's make that 6,800. Year after that, let's make that 6,900, 7,000, whatever, right? And then more importantly, not only acquiring new properties, because that gets expensive. They have to spend millions or billions of dollars to constantly buy out new properties. But not only that, they're older properties. Fixed rate increases, variable rate increases, hybrid fixed slash variable rent increases capped by CPI. So some of them are just based off of contractual amount saying, hey, we're going to charge you X, and next year we're going to raise the rent 1% after that. And then next year after that, another percent after that, and another percent after that. And so that will steadily increase their revenue and profitability without having to really do anything. And then variable rate increases based off of the client's sales. If the company beats X revenue goal, X profitability goal, if the company says, okay, if you make over $100 million in profit this year, we want a bonus. We want a percentage of that. We want a 1% bonus of all the revenue or all the profit that you achieved. And another one is CPI based, as in basically inflation, the consumer price index. If inflation goes up 5%, then they might be raising the rents half of that, 2.5%. If inflation goes up 10%, they might raise it half of that as well. Whatever the contracted amount is, 5% year over year. Once again, increasing revenue and profitability from properties that they bought 10, 15, 20, 25 years ago, and they're still becoming more and more profitable, as well as the new properties that they're buying every single year. Now, how has that company performed? With that type of business model, with that type of structure, how's the company performed? Well, they went public in 1994, and we can compare this to 4 different types of investments, and most of these being very popular. The blue line, the top one up here, is the Realty Income stock. That is the performance of the stock from both share price and dividends. And then next up, we have the yellow line, the Equity REIT Index, right here. It returned $1,300 out of your $100 investment, while Realty Income was $3,400. Definitely a different performance on your investment. Next up, we have the Dow Jones, one of the most popular tracking methods for tracking the stock market. The Dow Jones is very popular, would have returned $1,500 out of your 100 compared to Realty Income's 34. Next up, we have the Standard & Poor's 500, i.e. the S&P 500, arguably the most valuable and most frequent investment that most people invest in, and that would return 1,400 compared to Realty Income's 3,400. Big difference there. And then you have the NASDAQ, you have the big tech companies that have seen a big boom over the last couple of years. That would have returned 1,700 compared to Realty Income's 3,400. And not only the share price and return on capital, but this shows the confidence of the dividend increases and the confidence that the management team has over paying out to shareholders. Now, Realty Income is required to pay out 90% of its net income in the form of dividends because of the way that the government has the tax code set up on real estate investment trusts. So this company, whether they want to pay dividends or not, they're flat out forced to. But this company wants to pay out dividends, which is why they named their company Realty Income. Realty, real estate, income, money. Income for owning real estate. It's that simple. It's literally the name. And that's why they've had a track record of raising that dividend not only every year but multiple times a year. And this is why you see steadily increases. And with the new acquisition that they just did, the merger with VERREIT, they should be raising this dividend at least 10% going into 2021 and 2022. So we'll stay tuned for that. Now, not only does this company have a good track record, but look at all what they've done. Let's look at the fact sheets from what they've done since 1994. Properties in the portfolios went from 630 to 6,662 as of the other day. Like I said, this number is about to be a lot higher. Assets to 450 million to 22 billion. Clients in the portfolio, different diversified customers from 23 to 600. Total number of industries from 5 to 56. Annual revenue 49 million to 1.6 billion with a B. Adjusted funds from operations, AFFO, 39.2 million to 1.173 billion. Analyzed cash dividends of 90 cents to 282. And what's really interesting, I went back to their historical performance and we can look at their revenue and their net income going up over time. But what I found interesting is that if we went all the way back to 1994, this company has a track record of returning positive returns to shareholders. And if you look right here, 28%, 42, 15, 14, 5, a down year that year. And overall, this company has way more up years than down years. And if you notice something, if you count all of these years, if you count this one, negative 8.7%, down 9% with 2, 3, 4, let's see, 5 years. So since 1994, when the company went public, that's 26 years, by the way. Out of the 26 years that this company has been traded on the public markets, out of 26, 5 out of the 26 years this company has produced a negative return. In most years, as you can see from these black numbers at the bottom right here, most of these returns are double digits. Some of these having even 30 and 40% return years back to back to back. Now, while this company obviously will have down years, it's not perfect, this company has a track record of the last 26 years, 21 of those being a positive return to shareholders, and that is what you have when you invest in an exceptional business, right? And of their clients, they're diversified. And so their number one client is Walgreens. And with that client, it's not some type of massive part of their portfolio where it's 20 or 30 or 40% of their revenue. And if something were to happen to Walgreens where they'd be screwed, right? Walgreens makes up only 5.5% of their revenue. And so if Walgreens hypothetically, which is not going to happen anytime soon, if Walgreens went bankrupt tomorrow, they're going to be just fine. And looking at their top 20 clients, including Walgreens, you'll see little asterisks next to some of their names, like with Walgreens, 7-Eleven, Dollar General, FedEx, Dollar Tree. A lot of these have an asterisk next to their name, that little star right there, right? And what that means, of the top 20 that are investment grade, they have the star beside them. And so let's see, out of the top 20, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 of the top 20 are investment grade clients. Very good numbers. And so it's good to know that while a company may have some losers, like what's happened in 2020, and LA Fitness struggled a lot from the pandemic, AMC Theaters, some of these companies are struggling from the pandemic or just in general with their dying business models. But a lot of these companies are not. Walgreens is doing fine. A little bit of a turnaround play. They're changing their business model. 7-Eleven is doing just fine. Dollar General, very defensive, just fine. FedEx, just fine. Dollar Tree, fine. A lot of the companies in this business are going to be just fine, and Realty Income is going to be one of the first ones to get paid because, like I said, capital intense businesses need real estate to operate their businesses. The old school business model is still around, brick and mortar stores are still needed, and Realty Income owns a lot of those properties that these businesses need to operate. But not only among those top 20 tenants are they investment grade, are most of them high quality, but across all different industries, from aerospace to consumer goods to entertainment, financial services, health and fitness, healthcare, office supplies, paper, sporting goods, telecommunications, wholesale clubs. There's so many different industries, and you can see how diversified this company is. And not only that, but not only are they diversified with diversified tenants and long-term leases for their properties with incredible investment-grade businesses, but this company has a track record of always having at least 96% of their properties occupied. Going back, you can see that, let's go back to during recessions and during bad times in the market. They had the dot-com bubble in 2000 and 2001, right? 1999, they had 98% of their portfolio occupied, 97 in 2000, 98.2 in 2001, 97.7 2002, but that wasn't the big one. Let's look at the 2008-2009 financial crisis, okay? 2007, 97.9%, 2008, 97, 2009, 96.8, and then 2010 was the worst number that they ever produced, 96.6%. That is so incredible when one of the worst times in American history, one of the worst recessions we've ever received, and real estate was the main focus of that, right? 96.6 of their properties were still occupied, still having revenue paid to them every single month, every single year, nonstop. This is the worst time ever, was 2010. And obviously going back to a normal economic time like now, 98, 99% is where this company typically operates, which is so much better than most types of real estate. Now, Realty Income, like I said, if you're looking at the sell rating, if you're reading articles like this, it tells you little to nothing about the business. It's all focused on a fake price target, a made-up price target. Oh, it has a track record of trading at this price and this price, so let's sell here and buy here. And it's only within a 10% range. Buy below 62, sell above 70, hold in between. And we're buying it and we're selling it because the dividend yield is a little bit higher than usual and a little bit lower than usual. And we said that you should buy here, sell here. It's all noise. This is the type of noise that you should not pay attention to. Own quality businesses, invest in those companies, hold them for the long term, and continue to see compounding returns over time. If you're worried about a 10% gap in share price, if you're worried about a historical dividend yield or what investors might be willing to pay for this company, you're probably going to be lost. Invest in a company like Realty Income that is going to be sustainable for the long term and continue to be profitable and pay out cash flows to shareholders. This is what I do with my portfolio. This is why Realty Income is one of the largest positions in my portfolio and will likely stay that way for years to come. Realty Income is one of the positions in my portfolio that I intend on never selling. For me to sell out of this company, it would have to dramatically change to where the business was no longer even sustainable. But that said, I am ride or die with this company. I will either invest in it for years to go on out as it grows and grows and grows, or I'll be riding it pretty much all the way to zero. So we'll see whether or not this sell alert has any merits moving forward. But thank you guys for watching all the way to the end. I really appreciate it. Like I said, $30 for getting signed up. So go ahead and check out that down below. Thank you guys for watching all the way to the end, and I'll catch you guys next time.